Okay, okay, Nilesh Shah now joins us. Nilesh, normally you do the talking, but for a change, I've done the talking. Would you agree with me?
Absolutely, Nikunj bhai. I agree in 100%. These are tough times, these are extraordinary times, and we must respond extraordinarily.
So, what could be that extraordinary out-of-box idea? Because U.S. Senate has passed a package which could be classified as a whatever we will do whatever it takes kind of an package. Do you think on the economy front something like that needs to come? And if I may use the Hindi word, ये कंजूसी करने का समय नहीं है.
Undoubtedly, we have taken an absolutely vital step of locking down the entire country, where number of patients in India are far lower than number of deaths in many countries like Italy and so on and so forth. Now, if we can take such kind of important decision to safeguard the lives, next priority should be to safeguard the livelihood. And compared to rest of the world, we do have some opportunities. For example, we have room to cut down interest rates. In US, we have seen interest rates being cut by 100%. On a base of 1.58%, they cut interest rates by 1.5%. In UK, we saw them cutting interest rates by 86%. On a base of 75 basis points, they cut interest rates by 65 basis points. Clearly, there is a need to cut interest rate massively. Second, we have seen intervention by US Fed as well as other central banks to stabilize the market. In the initial stage, US Fed announced intervention in bond market by $500 billion and mortgage-backed security by $200 billion. Then they increased to include munis of $200 billion. Then they increased $1 trillion for commercial paper. And when they realized that that is not proving to be adequate, they said now it's unlimited intervention till such time market behaves. We need to intervene not only in government securities market, which RBI has already begun. They talked about first 10,000 crore OMO, then 30,000 crore OMO, then 1 lakh crore variable repo option. Now they need to move to intervene in CP market, CD market, PSU bond market. Clearly, they need to ensure that market is stable, market is functioning, and market is not in panic mode. We believe if you take early action, then it calms down the market and the panic doesn't spread. When panic spreads and you take action, then you have to do heavy lifting. The third thing is related to providing weaker section of the society. Clearly, 21 days lockdown is going to impact their livelihood, their income, their ability to survive. And we must do everything needed to support that. Fourth will be tackling needs of the businesses. Clearly, they are cooperating to end this epidemic by forcing 21-day shutdown. But same support should be provided to them on a reciprocal basis so that their moratoriums, their EMIs, their loan installments, their interest payments are taken care. Yesterday, we saw Finance Minister announcing host of steps to ensure that on compliance side, enough time is given to people to comply. Now we need to move to financial side, and she did talk about launching of a stimulus package or a financial package. So that should support the businesses. If I have to summarize, we need to do two things. One, what we did in the early to mid 90s in Surat, when we were hit by a plague, the citizens, the government, the state government, local government, all came together to eradicate plague from Surat. What Surtis did in the mid 90s, all Indians have to do in India. Second, we have to adopt 2008 spirit. In 2008 global subprime crisis, India did suffer, but we could overcome that through quick and deft responses from the regulator, from the government, from the market participants. If we copy on a much broader basis the Surat model and the 2008 responses, I think we will be able to overcome this current tough challenges.
Sure. But Nilesh, the question is, how much is enough? The US Fed has said that whatever it takes, they've opened their coffers. It's like a running tap. They will take whatever it takes to try and rescue the economy in such a pandemic case. We were just chatting with the Indian Retailers Association, and we had Future Retail as well join in on the show. It's a grim situation. Before that, we were talking to one of the cement players. Again, the same situation. No one has answers as to how they're going to pay their daily wage workers after a month because all coffers would dry up. The point is, how much will it take from the government's end, and how much can the government really do to try and, sort of buffer up the hit that the economy is taking because of this lockdown?
Obviously, these are very, very challenging times. We haven't seen such kind of thing on a larger basis. I think the only lockdown experience we have is going back to the mid-90s and see how Suratis and Surati businessmen scoped about it. But clearly, one, we need a mindset change. A positive mindset is necessary. If you just do a thumb rule calculation, there will be 21-day lockdown and just round it off by 9 days to 30 days. That's roughly about 8.25%. If we function on a yearly basis, what kind of growth we are going to generate by shutting down our businesses for about 30 days, we'll be generating 91.5% of growth. Now, 8.5% drop is dramatic, but this is not permanent damage to demand. For example, if you were going to buy a car in the month of April, you are going to defer it to probably June, July, August, but it's not going to be cancelled. At the same time, person who was going to buy a car in June, July, August, he or she may continue to buy. Then there are certain sectors where the cancellation of demand is permanent damage. For example, if you are going to watch a movie today or going to eat a restaurant today, now that you have to defer. You're not going to go more in restaurants in June, July, August to compensate for drop in April and March. So clearly there is some deferment of demand, and hence this 8.25% of drop down can be compensated. Clearly this is the time where we just have to take all the necessary steps without looking at the fiscal constraint, without looking at monetary constraint. Let's just stabilize things, and then we'll figure out how to scale it back, how to take it back.
As an investor, though, Nilesh, just wanted to understand, Howard Marks in his latest note to his clients is saying that believes that this is a good time to invest, and we're at the bottom of the pessimism. Are you getting those feelers from the equity prices? Are we at the bottom of it all? Or do you think this is an unprecedented situation and this is going to have a long-lasting impact even on equities?
I don't think so. It's going to have long-lasting impact. A month in the cycle of decades and centuries for a country or a corporate are not going to make a long-lasting effect. More importantly, today's market is discounting what is the uncertainty, what is the near term, complete lockdown, complete shutdown. But the same market a month down the line will also be discounting steps taken by government to support economy, to support growth. So their sentiments could change significantly, even though fundamentals will take more time to change. Third thing, as Howard Marks mentioned, these are great times to buy. But only caveat I want to add is we don't know where the bottom is. In times like this, it's always impossible to predict the bottom. So yes, these are attractive levels to invest into. These are levels at which one should be overweight equity. But please still don't go lump sum into the market, because markets could be volatile in the near term. Take every correction as an opportunity to invest. This is the learning we had from 2008 subprime crisis. We thought in those days, after 21,000 Sensex corrected to 15,000, it was good time to buy. At 12,000 also we felt the same way. At 10,000 also we felt the same way. And 8,000 also we felt the same way. We only knew that at 8,000 it was the best time to buy. much better than what we were buying at 10 and much better than what we were buying at 12. But we didn't know if 12 was the bottom or 10 was the bottom or 8 was the bottom. So don't try to time the market, take advantage of the current valuations, current volatility. Keep on increasing your risk exposure to equity in tranches in a systematic transfer basis.
Nilesh, we've heard this morning various voices. Some saying it's time to buy, it's a screaming buy, and some saying they would still sit this out until there's clarity. If you are buying, where would you look? What would you look at? Would it be, what's perhaps withstanding pressure right now, or would it be with an eye to the recovery? Clearly, names like financials, stay away from industrials. What would be on your radar?
So we are looking at companies across from a valuation point of view, and more importantly, their ability to survive the downturn with limited damage. One theme which I can summarize is that the bigs are going to become bigger and bigger. There will be flight to safety, there will be flight to quality. In this downturn, companies which have cash on balance sheet have better opportunity to survive than companies which are leveraged. So our focus is, one, looking at the valuation, second, looking at the survivability and ability to participate in recovery as and when it comes, and third, quality and safety. So the big becoming bigger is something which you will see across our portfolios.
Okay, thank you for joining us then.